to how Binance obliterated traditional currency exchanges. Picture this. You're a businessman in Lagos trying to send $50,000 to your supplier in Shanghai. In 2016, you'd walk into a traditional Forex broker, fill out mountains of paperwork, wait 3 to 5 business days, and watch as they carved out a brutal 4% fee from your transaction. That's $2,000 vanishing into thin air, just for the privilege of moving your own money across borders. Meanwhile, banks were making absolute fortunes from this captive market, processing $6.6 trillion daily in foreign exchange transactions while charging fees that would make a medieval tax collector blush. But in 2017, a company called Binance was about to torch this entire ecosystem to the ground. Changpeng Zhao, known simply as CZ, launched Binance with a vision that seemed almost laughably ambitious at the time. While traditional Forex brokers were still using systems that hadn't fundamentally changed since the 1970s, CZ was building something that would make their entire business model obsolete. Binance wasn't just another cryptocurrency exchange, it was a financial weapon of mass disruption. Within months of launching, they were processing over $1 billion in trading volume daily, but here's the kicker. Their fees were a microscopic 0.1%, not 1%, not 0.5%, but 1/10 of 1%. Traditional Forex brokers charging 3 to 5% suddenly looked like dinosaurs in a meteor shower. The numbers were absolutely devastating for the old guard. Western Union, the undisputed king of money transfers, was charging customers an average of 7% per transaction in 2017. MoneyGram wasn't much better at 6.5%. These companies had built their entire business model around the assumption that people had no choice but to pay extortionate fees for international money movement. They controlled the infrastructure, they had regulatory approval, and they figured they were untouchable. They were catastrophically wrong. Binance launched with support for over 150 cryptocurrencies, each capable of moving value across borders in minutes, not days. By 2018, Binance was handling over $2 billion in daily trading volume, making it larger than most national stock exchanges. The traditional players tried to fight back, but they were bringing knives to a nuclear war. Banks like JP Chase were still charging customers $25 to $40 for international wire transfers, plus a foreign exchange markup of 2 to 4%. The entire process took 3 to 5 business days because money had to flow through correspondent banking networks that looked like a Rube Goldberg machine designed by someone who hated efficiency. Binance users could move the equivalent value in cryptocurrency across the globe in under 10 minutes for less than $5. The contrast was so stark it bordered on comedy. Traditional Forex brokers were selling horse-drawn carriages, while Binance was giving away rocket ships. The regulatory moats that traditional players thought would protect them turned into quicksand. Countries around the world started recognizing cryptocurrency as legitimate financial instruments. Japan approved Bitcoin as legal tender in 2017. The European Union began drafting comprehensive crypto regulations. Even China, despite its complicated relationship with cryptocurrency, couldn't ignore the technological superiority of blockchain-based value transfer. Binance adapted to this regulatory landscape like water flowing around rocks, obtaining licenses in Malta, expanding to over 180 countries, and building compliance systems that made traditional brokers look amateurish. By 2019, they were processing more daily volume than the London Stock Exchange. The Forex industry's response was a masterclass in how not to handle disruption. Instead of adapting, most doubled down on their existing model. They spent millions on lobbying for stricter cryptocurrency regulations, convinced that government protection would save them from technological obsolescence. They launched marketing campaigns emphasizing their decades of experience and regulatory compliance, completely missing that customers cared more about speed and cost than corporate heritage. Meanwhile, Binance was innovating at light speed. They launched Binance Smart Chain, created their own stablecoin ecosystem, and built futures markets that offered leverage and sophisticated trading tools that made traditional Forex platforms look like calculator apps from the 1980s. The death spiral accelerated dramatically during the COVID-19 pandemic. As global supply chains scrambled and international commerce went fully digital, the limitations of traditional currency exchange became impossible to ignore. Small businesses needed to move money quickly and cheaply to survive. Traditional banks, struggling with their own operational challenges, actually increased fees and lengthened processing times. Binance, operating with a fully digital infrastructure, saw trading volumes explode to over $30 billion daily by 2021. They had become larger than most traditional financial institutions, processing more international value transfer than Western Union, MoneyGram, and dozens of smaller players combined. The knockout punch came with the rise of decentralized finance and stablecoins. Binance didn't just facilitate cryptocurrency trading, they created an entire parallel financial system. BUSD, their dollar-pegged stablecoin, allowed users to hold digital dollars that could be moved instantly anywhere in the world. Cross-border payments that previously required multiple intermediaries, days of waiting, and percentage-based fees could now be completed in minutes for pennies. By 2022, the total value locked in DeFi protocols exceeded $200 billion, with much of that activity flowing through Binance's ecosystem. Traditional forex brokers found themselves competing not just with one company, but with an entirely new financial paradigm that made their services irrelevant. The carnage in the traditional sector was swift and merciless. Forex brokers that had operated for decades began shuttering operations. Trading volumes on traditional platforms plummeted as customers migrated to cryptocurrency alternatives. Even the survivors had to slash fees to remain competitive, destroying their profit margins. Companies like FXCM, once giants in retail forex trading, saw their market caps collapse as investors realized their business model was being systematically dismantled. The $6.6 trillion daily forex market didn't disappear. It just moved to platforms like Binance that offered superior technology, lower costs, and faster settlement. By 2023, Binance was handling over $70 billion in daily trading volume across spot and derivatives markets, cementing their position as the world's largest cryptocurrency exchange and a legitimate threat to traditional banking itself. This wasn't just creative destruction, it was technological evolution at its most brutal. Binance proved that in the digital age, controlling physical infrastructure and regulatory relationships means nothing if your technology is inferior. They showed that customers will abandon decades-old relationships the moment someone offers dramatically better service. The traditional forex industry had grown complacent, extracting maximum profit from a captive market while investing minimally in innovation. When Binance arrived with blockchain technology that could do everything traditional systems did, but faster, cheaper, and with greater transparency, the outcome was inevitable. The $6.6 trillion forex market didn't need traditional brokers anymore, and Binance had given customers the tools to prove it. In less than 6 years, a company that didn't exist had obliterated an industry that thought it was untouchable, turning century-old financial institutions into footnotes in the history of technological disruption.